2 words, Revo Fitness. Here's a few more. Simple, 24/7, reformer Pilates, body scanners, massage chairs, squat racks, free weights, pin and plate loaded equipment, no lock-in contracts, no bullshit. All of that and more from just $9.69 a week. That's surprisingly affordable. Join now at Revo Fitness Mirrabooka or download the Revo Fitness app. RevoFitness.com.au or find the Revo Fitness app in the App Store.
Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Reporting season is in full swing, and last week we saw results from a host of big Australian companies, including Commonwealth Bank, JB Hi-Fi, CSL, IAG, a bunch of them. Already we're seeing some themes emerging. So today I wanted to look at the 3 key themes that have come out of earnings season so far and what that means for the rest of the companies still to report. Of course, the information in this episode is general in nature, doesn't take into account your own circumstances, so you should always do your own research and seek professional advice before making investment decisions. Lochlan Halloway is the equity market strategist at Morningstar. Lochlan, welcome back to Fear and Greed.
Thanks for having me.
Do you like earnings season, Lochlan? Do you actually get to see family and friends or not?
Look, it's a busy time. It's a busy time, but it's an interesting time because if you are an investor, this is the opportunity to open up the books and take a look at how management's allocating, your capital as a shareholder and how your business is performing, and that's a great thing. So, to the extent that we can provide a little bit of clarity for our clients during this very busy period, that's rewarding. But yeah, it's busy. No two ways about that.
Okay, so let's jump into it. We're looking at 3 key themes that have come out of the results so far. So give me the first one.
Yeah, so from us, I think we'd call out the recovery of the consumer, or tentative signs that the consumer is recovering. We've seen some evidence. Obviously, we're still early days of earnings season, right? I mean, as of Thursday last week, I think we had 34 companies that reported out of about 180 companies we cover that will report this earnings season. So it's very early days, and we have to recognise that when we're making broad, sweeping generalisations about themes. But what we are seeing so far is that there's evidence that we are seeing a bit of a pickup in retail and in the consumer and the health of the consumer. Thinking about results here, JB Hi-Fi's really impressed us in terms of their sales number. 8% sales is quite strong, and it suggests that the momentum is coming back. And the trading update they gave after the half had finished also looked fairly positive. We're also seeing some, positive results from the smaller retailers, the online pure players like Temple & Webster and Kogan. They're getting strong numbers as well. So it looks like we're getting a bit of a resumption in terms of the consumer. And I suppose relatedly with Commonwealth Bank's numbers and their reduction in financial hardship, it's also suggesting that things are improving as the labour market remains strong and the tax cuts start to hit bank accounts. So generally, that's the first theme that we're seeing in this early stage reporting season.
And this, of course, before any interest rate cut that we might get this week.
Yeah, exactly. It's interesting to see that it's kind of a bit preemptive. Obviously, the RBA finished hiking rates a while ago, and perhaps now the worst, so to speak, of the tightening is now sort of filtered through the system. Like this was sort of peak impact of the rate hikes, and maybe that's stabilised, and then you get the additional sort of kick, so to speak, of the energy bill subsidy and also the tax cuts. So it's encouraging, and obviously for retailers, you'd think all things considered, things should get better, and that's what we're expecting in the year ahead.
I love the fact that JB Hi-Fi is almost the first company. Well, it's not the first, but it's among the first, and Harvey Norman's always just about the last company. So those retailers always bookend reporting season. Okay, that's theme number 1, the consumer discretionary stocks, retailers doing probably a bit better than thought. Theme number 2.
Yeah, look, I'll stay in maybe the consumer sector here with retail, part of the landscape, because another thing we've picked up on, and we've been talking about it for a while, is the online e-commerce shift and how that's progressing. So we've held the view for a while now that retailers with a strong online presence are omni-channel retailers, like both brick and mortar and e-commerce, that have strong retail or digital platforms, and the pure plays over time should be the winners as more and more people move online. We're seeing, again, early days, we're seeing signs that's resuming. After, obviously during COVID, that sort of went through the roof in terms of online penetration and migration, and then as things reopen, it pulled back a bit, but we're seeing that trend resuming again. And that's sort of consistent with our view about how things will play out. Again, to go back to 2 names I spoke about earlier, but Kogan and Temple & Webster, Kogan sales, I think in fourth quarter were up about 10%, Temple & Webster in the half for something like 24% growth. So we're talking really phenomenal growth rates, even against, JB, which is again, it's predominantly a brick and mortar retailer, but its online platform, again, had really strong growth, outpacing its brick and mortar. So it looks like it's also taking share from the other name you mentioned, Harvey Norman, which has lower penetration online. So that theme we're seeing start to play out. And again, those companies that are indexed or positioned well for the e-commerce transition seem to be the winners, at least thus far.
Stay with me, Lochlan. We'll be back in a minute.
2 words, Revo Fitness. Here's a few more. Simple, 24/7, reformer Pilates, body scanners, massage chairs, squat racks, free weights, pin and plate loaded equipment, no lock-in contracts, no bullshit. All of that and more from just $9.69 a week. That's surprisingly affordable. Join now at Revo Fitness Mirrabooka or download the Revo Fitness app. RevoFitness.com.au or find the Revo Fitness app in the App Store.
My guest this morning is Lochlan Halloway, Equity Market Strategist at Morningstar. So, a third theme. So, we've had the first one being the return of the retailers, the second being the online plays looking okay. The third theme, Lochlan.
Yeah, sure. So we'll switch it to the miners, basic materials. And obviously, the gold story has been really fantastic for investors there and for those gold mining companies exposed to that theme. But I think one that's more important for our market, and I'll talk about that, is obviously how the iron ore miners are faring. Things are, if we look at where we were last year, we've got iron ore prices off some 16%. And obviously that's an impact for our big iron ore miners, BHP, Rio and Fortescue. Somewhat offsetting that for BHP and Rio is improvement in the copper price. Fortescue doesn't have so much exposure there, so it's not as much of an offset for them. So how that plays out for the rest of the year is going to be something we're watching very closely. With all this talk of tariffs and the potential knock-on effects for the China growth story and steel end user demand, it's something that we have to keep an eye on. We see both BHP and Rio as close to fairly valued now, which we haven't for quite some time. So it looks like the risks there are more or less priced in, which is good because it opens up an investment set in the market, which we haven't seen as offering a lot of value for a while now. But how that plays out is going to be very important.
Okay, I'm just interested in Donald Trump and the US administration, and this kind of follows on from the miners and base metals and tariffs, potential tariffs. We don't really know. That's a day-by-day proposition, exactly how that's going to be implemented. But I know Ansell came out last week and talked about, increasing prices on the back of tariffs. CSL, vaccination business, a bit tough when the head of health in the US is anti-vax. I think Macquarie was another one who came out talking about the sale of renewables and how that affects Donald Trump affects that. Has that Trump thing, we seem to be hearing about Donald Trump and the administration in reporting season, not surprisingly. Has it actually had a material impact, do you think, and will it?
Look, I mean, you wouldn't expect to see too much so far. I mean, in the last half of last year, obviously that was very early days for Trump. So I wouldn't expect it to be visible in the results that we're going to be seeing over the next couple of weeks. The outlook, yes, you would expect things like tariffs would have an impact on certain companies that are exposed that way. I mean, perhaps we can talk about a few of those in a minute. But we've got to be cautious, in my opinion, of a couple of things. Firstly, how much we don't know about the outlook for tariffs. It's a story that's changing by the minute. I mean, last year, as during Trump's election campaign, there was talk of a 10% universal tariff and a 60% tariff on China. Now we come to, his early administration and we have the 10% tariff on China and then tariffs on Canada and Mexico, which were then suspended. Now we have talk of reciprocal tariffs. It's evolving by the minute, and I think we'd be cautious about making, so to speak, one-way bets on the outcome of a tariff because we just don't know what's going to happen and nobody knows what's going to happen. But to give, a counterexample, I mean, one company that we've talked about that would be a beneficiary, for example, of tariffs on global steel imports to the US would be a company like BlueScope. And, the share price has, broadly speaking, reflected that. That's true if tariffs play out, as to the extent we expect that Trump does put tariffs on and they do stay in place. But I think the more interesting case probably, and you kind of miss this if you just start applying these broad brushstrokes of, well, this company is an importer, this company is an exporter and from China and so on, is that some companies with, moats, competitive advantages can actually do quite well, even in environments where you have a tariff. And the example, the case study I've sort of used for the last week or so is Breville. And Breville is a manufacturer, obviously, of home appliances, and about half its revenues earned in the US. But it manufactures almost all of this in China. So on the surface, you'd say, all right, Breville's a company that is unfavorably exposed to tariffs on China. And, in the binary sense, that is true. But in the last trade war in 2016, Breville's margins didn't even budge. It passed it straight into the consumer because it has a fantastic brand perception in the US. It's luxury, it's well placed, and has a lot of pricing power. So it just sort of, completely rolled through that, really without any sort of, obvious impact at all. So if you can find those companies that have these competitive advantages, they can sort of buck the obvious knee-jerk response to tariffs. And a moat's a valuable thing in any environment, particularly when you've got this much uncertainty. I think that comes into even sharper focus.
Okay, so kind of quality companies that with pricing power probably won't be hit as hard as the more commoditized organizations.
Yeah. Well, I think they have more of a capacity to be able to pass it on to the consumer. So I think that's fair. Obviously, generally speaking, there'll be impacts, but their ability to withstand that and to pass it through looks much higher.
Final question, Lochlan. Week one, well, it's not week one, but the first big week is over. Do you have a favourite result? Do you have favourite results as an analyst or not? You're not supposed to.
Well, I mean, the ones that catch our eye, obviously, I think, we've seen this as fairly positive overall in terms of earnings season. I mean, as I said, we cover about 180 companies, and as of late last week, about 20% or so had already reported. And generally speaking, we provide just for context, we provide a fair value for each business. So it's a DCF-based valuation, and we've upgraded our valuation for about half the companies that have reported. We haven't made any downgrades yet, and the other half that we didn't upgrade, we just maintained fair value for those businesses. So overall, that's actually a pretty positive start. Yeah. And we had some really big results. Like I said, JB Hi-Fi we talked about earlier, we upgraded that fairly substantially. I think about 7% on the day because its sales, was taking a lot of share, and its sales were stronger than we were expecting. So that's positive. Still, in our opinion, looks overvalued, but it was a strong result. So that's one I'd call out as being positive. But generally speaking, the signs we're seeing so far, caveat that it's early days, are that it's been a positive earnings season to date.
Lochlan, thank you for talking to Fear and Greed.
Thank you.
That was Morningstar Equity Market Strategist Lochlan Halloway. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.
2 words, Revo Fitness. Here's a few more. Simple, 24/7, reformer Pilates, body scanners, massage chairs, squat racks, free weights, pin and plate loaded equipment, no lock-in contracts, no bullshit. All of that and more from just $9.69 a week. That's surprisingly affordable. Join now at Revo Fitness Mirrabooka or download the Revo Fitness app. RevoFitness.com.au or find the Revo Fitness app in the App Store.